Ever wondered how companies recognize their revenue? The process might seem complex, but it's guided by a set of principles known as IFRS 15, or International Financial Reporting Standard 15. This standard, developed by the International Accounting Standards Board, offers a framework to identify, measure, and disclose revenue from contracts with customers. Now, let's dive into the heart of IFRS 15, the 5-step revenue recognition model. Step 1 is about identifying the contract with the customer. It's about knowing the existence of a contract, recognizing the parties involved, understanding the rights of these parties, the payment terms, and the commercial substance of the arrangement. Step 2 is about identifying the performance obligations. Within the contract, there are promises to transfer goods or services to the customer. And each of these promises is a distinct performance obligation. Step 3 is about determining the transaction price. This is the amount of consideration a company expects to receive in exchange for transferring the promised goods or services to the customer. Step 4 involves allocating the transaction price to the performance obligations. This means dividing the transaction price based on the relative standalone selling prices of the promised goods or services. And finally, Step 5 is about recognizing revenue when performance obligations are satisfied, either when or as the entity transfers a promised good or service to the customer. But IFRS 15 is not just about recognizing revenue. It also provides guidance on how to handle costs incurred to obtain or fulfill a contract. These costs can be capitalized if certain criteria are met. Moreover, IFRS 15 demands extensive disclosure. This helps users of financial statements understand the nature, amount, timing, and uncertainty of revenue and cash flows that arise from contracts with customers. And how about transitioning to IFRS 15? Entities are required to apply IFRS 15 using either a full retrospective method or a modified retrospective method, with practical expedients available to ease the transition process. In essence, IFRS 15 is about a principles-based approach to revenue recognition, with the transfer of control over goods or services to customers as the core principle. It's crucial for entities to assess their contracts carefully and apply the 5-step model to ensure compliance with the standard. And in complex transactions or industries with unique revenue recognition challenges, professional advice may be necessary. So there you have it, the 5-step model of IFRS 15, a comprehensive guide to recognizing revenue. It might seem like a lot to take in, but remember, it's all about providing a clear, consistent framework for recognizing revenue from contracts with customers.